Hi, David Moore with Equity Advantage, and I'm blessed to have Rene Nelson of Pacwest Commercial from Eugene, Oregon with me today.
Hi, David.
And I was I was blessed to be on her podcast a few weeks ago, a month ago or so, and I don't think I let her talk. So today I said she's the one that's going to talk, and here she is telling me that I'm the one that's going to be answering the questions yet again. She knows me too well. But it's great to have you here, and I think back through the years, all the fun we've had doing different things. I think back that trip up to Seattle with Craig and Bob, and driving back and forth telling stories the whole time, and that was sort of a neat deal, because I think the one thing that, and Renee's wonderful, she's a past president of the CCIM chapter here, and she took offices beyond that. But one of the great things about our local chapter at CCIM is just that marketing sessions. I'd say it's the best thing of it. And it was really neat to go up there with you and Bob and Craig and have the Seattle chapter at Seattle Yacht Club wanting to learn from us. And
Yeah.
It was a great trip.
Yeah, we had a blast. We really did. We've been friends for about 30 years?
A long time.
Yeah, a long time.
Because I met Bob in 1990. And I met you shortly thereafter.
Yeah. Well, luckily with our CCIM connection, we've remained friends, and I'm just blessed to be here today. I feel like I'm sitting at the foot of the master and the guy that has the answers. So I have, as you know, I've been in real estate for quite a while. I've been a CCIM since 2014, so that dates me right there. And I have a lot of longtime clients who are aging. They're in their, what I call the fourth quarter of their life. So they're widowing, spouses are dying, as you can look at any statistic, and most women will outlive their husbands. My husband passed 3 years ago. David, I made a deathbed commitment to my husband that I would always rely on David for expertise, knowledge, and to bounce ideas off of. You need that in your life when you're a widow, because there are people out there that will just give you advice without really caring about the long-term outcome or knowing enough information to give you every strategy, like, well, you need to know this and you need to pay attention to that. So I'm here to pose a couple of questions to you. You ready?
I'm happy to answer those. and Bob, I was blessed to have him as one of my mentors, and the 1031 guru. And like you said, I think it's so critical that in life you have people to learn from, and you can take the bumps and bruises on your own, or you can at least have them a little bit lighter and softer if you're learning from somebody else's mistakes. And we had just a couple of weeks ago at CAB, I presented the Rookie of the Year award, which was just fun for me because I told some stories, and you've heard me say it, I'm always happy to learn. I'm getting tired of being taught at this point in my life. So I'd rather sit up here, and it's nice to be at a point in life where you don't have to do every deal. You're going to work on the ones you enjoy, and you're not going to cram that square peg in the round hole. So I think that's one thing that you definitely learned from a master that way. Not me, but Bob, and that's a whole nother story how you guys met. But so many great times and stories to be told, and it's the stories that ultimately help get us the deals done and help people understand what's possible. So I like to say it's not the deal, but it's the destination. So I will, and by the way, whether the women outlive the men for one reason or another, I'm married to an Italian, so she says she's married or a widow. So if I ever disappear, you know where to find, start looking, okay?
Black plastic, zip ties, shovel.
Yes, definitely. But why don't you fire right away? We'll answer a few questions and see where we go with this.
Okay, perfect. For a lot of my clients, it's that fourth quarter of life, and they don't want to lose it because they can't earn it again. It's really tough to make it up when you're 60, 65. And as we chatted before we started the podcast also, for a lot of people, they work so diligently to get ready to get into retirement. And then statistically, life happens, and then they may have a health issue. So all of a sudden, instead of living to be 85 or 90, that gets shortened, or they have to deal with cancer or a health outcome that really makes an impact. So I'm here on behalf of my clients who are, say, 60 to 75 years old, and they're trying to figure out, okay, I live in this big house.
Yeah.
My kids are all gone. So let's say the house is worth $1 million. Husband has passed away, so now she's a widow. $1 million house, and it's, like 3,000, 4,000 square feet, way too big for a single person. You got to hire a cleaning crew just to come clean the dust and the cobwebs.
How big's your house right now?
No debt, obviously. Over the years, you've paid the house off, and now you want to sell. So if you're going to take your $250,000 exclusion that the government gives you, there's still some cash there, or some equity, I should call it.
Yeah.
How do you deal with that? So somebody wants to sell their house.
Yeah.
How do they do that?
So we like to say it's just end games, right? And,
Yep.
and the first thing you got to look at is in that scenario, if somebody just passed away, then half the property got stepped up basis current market value. So you look at this stuff, and the thing that's interesting too, you've got to look at, and we'll deal sort of this exercise with clients. I mean, how many quote unquote Oregonians do you know that spend most of their time in Palm Desert these days?
Quite a few.
Quite a few. And even if you look at the state tax at, let's say, 13.3 on the top versus, maybe up to 11 here, you think, well, it's a couple points cheaper in Oregon. Well, the estate taxes, Oregon doesn't follow the federal guidelines. California does. So you're way better. If you've got high net worth, you're way, way better off passing away in California than here, believe it or not. Mm-hmm. So that's the first thing we sort of look at, because you and I typically are living in a capital gain deferral situation, right? And that's, so we've got two businesses in here, and it's sort of interesting because the qualified money, IRA 401k funds, we'll do tax deferred exchanges for somebody for 10, 20 years. I never see them. And then we do a retirement account for them, and they're in my office. And so why are you here now? And those of you that have heard my presentations before hear me say that. And it's really interesting to me because for some reason they look at that IRA 401k money differently. Well, that's my retirement, where what are we talking about right now? We're talking about a home that represents retirement, or we could talk about income properties that represent retirement. So it's sort of interesting to see how people look at things differently. But on that home, you've got to look at the Section 121 came into play in 1997. And gives an individual $250,000 exclusion, a married couple $500,000 exclusion on gain. And it's not a one-time deal. You can do it over and over again, just separated by 2 years. And those rules in 1997 made sense. Today, I'd say the old residential rollover 1034 would be better for a lot of people, because you think about your investors that have lots of real estate. How many of them have that scenario you're just talking about? The $1 million sale, or maybe a gain. If it's $500,000 or less married, that's something. But now you're single, $250,000 out of the thing, and then you start adding it up, and what's you might have a $2 million house, $3 million, $5 million house today, and that's a whole different situation. So we always sort of look at it and say, okay, well, let me ask you this. I know you have a home office. Do you treat it as such?
I don't. My CPA advised against doing that, so I don't have a home office.
So think of the clients that, and I would probably tend to agree with that, but depending on what you're trying to do, it may or may not make sense to do it. So, and what I mean by that is you can have the sale of a primary residence if you've got a home office in it, if it's been treated as a home office for more than 2 out of the last 5 years, it has to be treated for 1031 purposes, or it's going to be taxed on a sale. So you can have a single asset with allocations both 121 primary residence and 1031. A more obvious situation. Remember Bill Hill? It was Bill Hill that had all the property up in the Mackenzie River, right?
Yeah.
And so in his properties, he had a lot of acreage. So you have the house, and then you've got that land. So who makes those allocations? You live in the institutional world, right? So how many of the projects you work with have cost seg done?
Probably about 20 or 30%.
Yeah.
You'd think more, but
So for the benefit of the people in the audience, cost seg, if you look at cost seg in the most minute sense, it's a rental house on dirt, right? I mean, you've got an allocation dirt to improvements, and people don't think, and we made a comment on your podcast about having a team and having people that are you're paying to do a job for you, not learn, right?
Yeah.
So if you just buy a rental house, what happens the ROI if you jack up the value of the improvements versus dropping them? So the more the improvements, more depreciation, the better your ROI. Cost seg is just taking that two-piece cost seg and breaking it into 100 components, right? Plumbing, lighting, heating, flooring, parking lots, all that stuff. And so when we start looking at this stuff, a home with a home office, that same thing can be applied. Or you've got the home on land, you're going to start looking at those allocations and what is property worth? You were in finance for a long time prior to the real estate, right? So have you ever had an appraiser disagree with your buyer and seller on a valuation?
More than once.
Or have a lender looking at a loan that didn't necessarily agree with that appraiser?
Yes.
All the time. Seems to me we had a big court case last year where the property was valued at 18 or 20 million, where it was maybe worth $1 billion. So there was a little discretion, that needed to be used in that situation, a little discrepancy in the valuation. So you're always going to look at those things, and you've got room for it. When we do retirement accounts, for example, when every year, and you've got IRA-owned property, so every year you've got to provide a valuation to the trust company. I'm fundamentally opposed to using any trust company that's going to charge one of my self-directed clients based upon the value of their account, because it's not black and white, and you don't want to be fighting with that trust company at the end of every year for those valuations. So you asked me a question. I don't know how far I've strayed from that answer by now, but you start. So I think your question was just looking at 121, that universal exclusion, and looking at a home. And I think where you wanted me to go was look at what something is and think about what you want it to be. So you can convert a primary residence into investment. You could have a primary residence that contains both investment and Section 121. You can take a 1031 property and exchange it into an investment that is ultimately converted to a primary residence. And all these things have rules that apply. And it's just a question of understanding what those rules are and taking the time to plan it out. And I know you learned from the master of planning stuff out, and counseling is what you do. And I mean, why don't you can sort of tell the audience the way you look at a transaction for somebody, but it's counseling is the first thing you do. I know that from your mentor.
Well, and that's true. And one thing that I always do with clients is I start with the exit strategy. When I'm getting someone into a property, the first thing I think of, okay, they're going to call me in year 3, year 5, year 10. How am I going to get them out? Are they going to come out whole? Is there any risk? Is there exposure? And I want to talk about that also with going from multifamily into a triple net asset as an example, just some of that structure also. But back to, let's wrap up on the personal residence. Because a lot of my clients say, well, if you die, then it goes stepped up basis to your estate, obviously to your kids. And a lot of people have their personal residence in a trust, trying to do the best tax planning and best strategy that they can. But they're always thinking, okay, I've got all this equity trapped in my house. But then when they look at going to buy a new house, housing prices in Oregon are crazy right now.
Yes, they are.
So for a lot of people, they just say, well, I can't replace something better unless they're going to downsize and go into maybe like a condo where they've got somebody that's going to take care of all the landscaping, the exterior maintenance, and maybe they're going to become a snowbird. And so having a condo makes sense because it's kind of a lock and leave. They lock their Oregon home during the winter. They go to Palm Desert. They go to Phoenix, wherever it's warm. Then when it gets too hot there, like in July, they lock that and they come back to Oregon, and that's just kind of that lock and leave concept. That strategy makes sense to me for people who want to maybe step down in size, kind of still have an Oregon residence. Maybe they've got kids that live here and that's their strategy. But at a certain point, I think a lot of people think, I've got all this equity trapped in my house. What do I do when I have health issues and I need to unlock some of that equity? Because, if you've started to retire, now your income potentially has gone down. It may be tough to go get a mortgage.
With suddenly you have to support the life you've created, right? I mean, that's what gets tough. And obviously it's not that we're old, but you start looking at that stuff just in your own life. But the main thing is just take a look at your home. That's where you start off. You look at what Section 121 says. It says an individual has $250,000 exclusion on gain. A married couple gets $500,000. To qualify, you have to have lived in the property for 2 out of the preceding 5 years. So it's not what it is at time of disposition. It's just any 2-year period. So we have a lot of people that will come to us, that often referred to us by a tax person or a lawyer, and says, hey, talk to these guys, and we'll tell them to move out of the house. Or you start sharpening your pencil on those allocations. But what are we looking at? That 250 or 500, people need to understand that you've got to say, okay, it's gain. And what is gain? Gain's just the adjusted sales price minus the basis. And your basis is the purchase price plus capital improvements minus depreciation. How many people have maintained records of everything they've done to their house during the time they've owned it? Okay.
Very few.
I live in that world and no, I haven't. So you've got to look at that, and you've got to deal with your tax people to understand what's a good number that's a defendable number in that situation, and then start looking back and say, okay, the 1031 has a cost. Converting assets has a cost. I mean, if you sit there and say, okay, gee, I don't want to pay the tax, and I say, okay, if you got gains beyond the 250 or 500, you don't want to pay the tax, you're going to move out of the house. And a lot of times people say, well, I don't want to rent it. And their tax bill say, well, it's got to be a rental property to qualify for investment. No, it doesn't. I mean, it's totally irrelevant whether it's rented or not. You just got to cap your personal use to, let's say, 2 weeks or 10% of the time that's rented. In this situation, I'd say at least a year predisposition. So you're just going to move out of it. As you said, you're going to establish a primary residence someplace else. How do you do that? Define a primary residence. And typically you're going to look at utility bills, voter registration, driver's license, car registration, tax returns, that type of stuff. But it's not, you don't dictate this is your place, and you don't dictate these are the parameters that are going to do it. So it's really talk to your tax people once again and see what they're going to be comfortable with you as far as establishing where you are with that stuff. But then if you move out, you've got that up to 3 years to sell that thing and still fit the 2 out of 5 as long as you've been there. And then it's a great thing. Now, if it's rented out, then you're going to have some depreciation that's going to be recaptured at time of disposition. And what you're going to be entitled to is those 121 numbers. And the overage, we're typically going to 1031 into something. So in your scenario, if you're downsizing, we're going to say, okay, and then understand 121 straight exclusion on gain. It's not a rollover. Mm-hmm. So you're just going to take that exclusion and go play with it. If you have overage, gains beyond that, then you can 1031 into, a lot of times they'll go into a DST, or they'll go into, maybe they buy another quote unquote investment property. Mm-hmm. And we'll talk about going the other way on stuff too. And the government has definitely tied hands on conversion and what happens with a property that's acquired via 1031, converted into a primary residence and sold. There's things that fit in there too. Mm-hmm. But I guess the main thing I want people to understand is don't get locked into what you think something is. And for you've done it long enough, and you've really worked both the financial side and the investment side, and you understand that residential piece too. But you know better than to assume that that deed actually reflects true ownership too, right? So we always have to look at who's on title and what and who wants to be on title on the replacement side. And then look at those exclusion numbers. If it's a primary residence, that's going to be important. But understand that the deed doesn't indicate ownership at all. If Rene were to sell me a property in a land sale contract, she'd have title till I paid it off, and yet I own the property. So don't get confused on what the deed says and think it dictates ownership. It doesn't. And there's a whole thing called a correction deed to fix those things. So. Mm-hmm.
Okay, that's super helpful. That puts my mind at ease, and my clients are going to be grateful and appreciative.
And confused.
Well, honestly, nobody is trying to beat the government out of the fair share of taxes. We all need public roads, safety. I mean, we all, as the average American, we all pay our fair share of taxes. I think everybody can agree with that. But my clients aren't trying to beat the system. They just want to figure out what's the best strategy. So one of the things that I also deal with for a lot of my clients is a lot of them own multifamily property. And for most of my clients, they've owned that property for years. Either it was given to them from their family, so generation to generation, and they've owned the property for 30 years. And let's say it's an apartment complex that they've just lifted it as high as they can with their current property manager, and now it's kind of tired, and they need to either go in and put a lot of money in and renovate it, which very few of my clients have the stomach to do that, because it's just really easy to lose your shirt in a renovation. If you're relying on a contractor, there's cost overruns. Now with tariffs, that is a moving mark for the cost of building material. So for a lot of people, they don't want to do a renovation and they'd rather just sell 1031 exchange. Most of my clients own their property free and clear. So with all that being said, most of the strategies that I help my clients do is sell a property, 1031 exchange into something better that still creates that passive income that they're looking for. And ideally is trying to get them more and more passive. Either they've self-managed over the years, and now in the new step, they're going to either have a triple net property like a Dollar General, where they're just going to get a check in the mail, or we're going to move up to a nicer property and they're going to put it with a property manager. That allows my client to take another step back and have less screening of tenants, toilets, trash. They're dealing less with the actual maintenance and the repair and the ownership of the property and just getting more passive income. So my question for you is, when you're looking long term and you're trying to figure out, okay, I want to buy a Dollar General and I'm going to own this for, say, 8 years or 10 years, because, most Dollar Generals and triple net properties often have a fixed term on their lease. So you may, if I'm just going to keep using Dollar Generals because I have a lot of clients that love that type of asset. You can buy any type of triple net. You could buy a Kentucky Fried Chicken, a Carl's Jr., anything where the tenant is responsible for the maintenance and the repair, and they just send you a check. That's a triple net type of property. For someone that's owned an apartment complex and they've self-managed it, now the concept of owning a triple net property is super great for them because it gives them more freedom. They can travel, they get dependable income. But for most of those Dollar Generals, as an example, if you buy one today, you're buying a Dollar General with a 15-year fixed lease. So that's 15 years of income. If you want to get out of that, you probably need to figure that you're going to sell at about year 8 or 9, where there's still some term left on that lease. Because if you wait until there's 3 to 5 years left on the lease, you're going to pay a pretty severe deep discount because there's risk. Nobody knows if Dollar General is going to renew that lease. So strategy-wise, I'm year 8 into a Dollar General and I could sell it, but is there a better strategy in your mind from like a 1031 position?
Well, I think take a look at you. You were involved with a few very large-scale developments in Eugene in the last decade, 15 years or so. And how long do the original builder developer, how long do they keep the asset?
Boy, if it's student housing, a year, maybe 2. They get it developed, stabilized.
So tell me what they do.
They get a development fee. They stabilize it, meaning they lease it up for the first year, and then they sell it off and take the money.
And the student housing, we got a year or two till it's beat up and they need new stuff. I'm just joking.
That's true.
But typically, you're going to look at maybe a 5 to 7 year cycle. Why? Because they did everything you just said, and they're going to sell it before it's needing a roof or it's needing plumbing repair, it's needing HVAC stuff. So your ROI is maxed out and you're at a point where you want to move on. I think individuals, so institutional investors like you've worked with, have a definite model they're using. The general public doesn't, right? I mean, you just sort of look at things, and so this gentleman, aside from, Mr. Nelson being one of my mentors, I had another one. It's like answer 3 questions. And I said on your podcast, 3 questions before you buy it. If you can't answer questions, don't buy it. What am I going to make? How am I going to make it? When am I going to make it? But understand that it was all based upon, and this comes back to your counseling and generating an ROI that you have to measure against everything. And you made a comment about refi. You look at a point where you say, okay, I've sort of maxed this stuff out, and I either have to do a cash out refi to get the leverage where I need, or I sell it. And your question just now is, you've done everything. So really the refi would be the course of action if you just loved the property, didn't ever want to give it up because it was that just amazing thing, or there was something else you could do to help it. But if you've done everything, then you really don't have a choice. You got to get rid of it. And so I always joke that Ron, the other mentor I had, always ruined Tom and my investments because he'd sit there and measure our own numbers against the asset, and it's like, when are you going to get rid? You can't afford to keep it. And we're going, wait. Anyway, so he'd shame us into it. But I think that it's really, you get to a point where you're working with people that are used to being hands-on. They're building their estate. They're doing everything they can. And it's a familiar thing to go from houses to apartments, right? Because people live there. It's just more doors. But they don't understand the trap that exists with the financing, like you're saying. Instead of 10, 20, 30, 40-year money, you've got 7-year, 10-year money.
Yeah.
So things are starting to have to come up, and you better deal with it before it gets to be a problem. And then you throw in a triple net, big box, single tenant situation, then you got the term of the lease that's there too. And you got to really be careful with it. And then you got to be watching, if you think about our interest rates 5 years ago or 3 years ago versus today. And so now you're looking at a situation where you might have to replace a loan in a completely different world. So you better be thinking ahead and understand what those options are. But yeah, the big box single tenant stuff is very attractive for people that understand it. I think it's a great way to go. It needs, the lease and investment's only as good as a tenant, obviously. So you better be a good tenant and you understand what you're dealing with going in, and understand that, like you said, that lease, the terms of the lease are going to dictate what ultimately happens with the ROI, and understand the value. If you hold too long, it's going to be changing for the same reason as the other stuff. I mean, you just maximize it. You got to look at it and understand what the maturity of that particular investment is.
Yeah. Well, and on the big box, that big box retailer is not fail safe. Also, think about in our career, we watched Shopko go down, and Circuit City, and now I think Joann Fabrics.
Yeah, Joann's, Walgreens.
Yeah. Yeah.
I mean, that's the thing. And big box single tenant. So the typical MO is what? People start with houses. They go to doors, they go bigger, they go plexes, and they go to apartments. And then somebody will say, hey, you ought to try something else if they're fortunate. They got into industrial, not office, right? But I joked that rookie of the year, he started off in development, and then he went into, I think it might have been some office, and now he's in industrial. I said, so you can tell he's smart too. Anyway, he learns. But you think about those different asset classes, you think about what was the gold standard and what is today, and it's a different place. And I always like to say a big box is big box single tenant is gold until it's not. So I've had my own experiences in that space. So it's really important that people understand, and I think we're in a space where, as we get older, as you said earlier, we're more concerned with wealth preservation than we are necessarily the ultimate ROI on stuff. We want to be able to enjoy our life. And I think that's, you talk to any financial advisor and talk about stocks, what are they going to tell you? Diversify. And I would say the same thing. You don't want to take your entire piggy bank and throw it into one big box. You better diversify into a variety of stuff and understand what's possible before you move forward. But it leads to the point of giving people a place to go, right? I mean, you're here, and the point of conversation is today, you say, okay, before you ever sell anything, understand the potential tax liability, and liability is one thing, exposure is one thing, actual taxes owed is another. So you got to look at and deal with your tax people, deal with your financial people, and really say, hey, this is what I'm looking at. This is potentially the gain I'm going to have in this situation. Can I sell some stocks to offset the gain here? What else can I do to mitigate it? Because that patient money is the gold that we all want to play with, right? 1031 money is very impatient. So you better be looking at planning proactively rather than waiting till something sells to think about where you're going with it.
Yeah, I would agree with that. Talking about selling, how do I convince my clients to get ahead of the curve and call your team and start talking about their exchange before we even sign a purchase and sale contract?
I think they need to realize they don't know what they don't know, right? I mean, that's the issue. And it's about, we like to say, we like to provide opportunities and solutions. And sometimes it's a problem that they don't know they have. For example, the phantom gain discussion we've had before. So I really think it's just a situation where, and understand, I've done a lot of the CE for the Oregon State CPA Association through the years too on 1031s and retirement accounts. And so we'll talk about these issues, and that's a great forum to sit and talk about the issues with the people that are actually doing the tax work, some of the top firms. And really to look at and say, hey guys, have you thought about this or this? And what's, once again, TurboTax is going to do a tax return for you, right? And maybe some tax preparer is going to do exactly what a tax preparer does, file a return. And I really firmly believe in today's world, it's so complicated that good tax people are, I believe, some of the most important people in our lives today. So to work with somebody that is going to do some planning, you don't want to call them for the first time April 10th, right? I mean, you better do it before, I would say before you ever sell anything, at least before year's end. You want to talk to your financial advisors too and really have idea what kind of exposure you're looking at before year's end. But the 1031's got an opportunity cost. You don't want to list and sell a home 2 months before your 24-month occupancy expires, right? And I've seen that happen. I mean, so it's not an elective proration of those numbers. They're hard numbers. So you need to really look at that and plan ahead and understand what potential liability you have and then the opportunity cost of whatever action it is. And as I said, if we're looking at somebody with a gain well in excess of 250 or 500 and we say, okay, move out, where are they going to live for 12 months? Okay, what's that going to cost? Oh, that might be $36,000. What's the tax liability? 40. Well, don't do it, right? I mean, if it's 100, yes, it makes sense. But that's that thing where people just want, well, I got to do an exchange. Well, maybe not. 121, understand where you are with that stuff. But, back to your question, you don't know what you don't know. So asking the question, have a conversation, and we like to say, we're not trying to sell anybody anything. I'm not selling them an investment property. I'm not selling them a DST. I'm not selling them a 721 or any of that stuff. But we deal with them day in, day out so we can agnostically say, hey, look at these things and consider them.
Mm-hmm. I just helped 3 sisters in a sale, and it was very interesting because one was going through a divorce, so that created some complications. Mm-hmm. And then one of them owned real estate. Well, she wanted to put her property in the name of an LLC that was out of Oregon, and that created a whole nother layer of complexity. Luckily, your team was able to handle that,
Good.
But there was just a lot of undue stress on my clients. And I really want to just counsel people and just say, call up front. It doesn't cost a dime more to ask those questions up front.
And if you can do it when there's not a time issue pushing you is a nice thing, right?
That's the key. Yeah.
So, back to people wanting to know when they should look at this stuff, it's when you're contemplating a sale. And I would say if the two of us were going to go buy something, we'd be talking about how we're going to own it during the time. How are we going to buy it? How are we going to own it? And then ultimately, I think 10 years from now, you and I are going to want the same thing. And then so you've got to sort of make that plan before you buy it, and that way it's a nice smooth thing. And even if we own something jointly via tenancy in common, how often do you have a jointly owned property where you actually see a tenancy in common agreement?
Not very often.
Not very often. And it should be there every single property, by the way, people. So, because even if we own a place in Sun River, 5 years from now, do you think we're both going to want it? And let's say it's got a loan on it, and I say I want out. You'd probably like to have first, right to say, okay, who's going to be sold to, and if there's going to be a refi of the property, it's going to cost you. So there probably should have been a TIC agreement that said, well, Mr. Moore, you're going to help me do the refi to keep this asset, right? Otherwise, but that's, once again, you don't know what you don't know. And I would say there's a bunch of you out there in the audience that probably have property jointly owned by somebody in Aspen or Vail or wherever it might be. Do you have a TIC agreement spelling out what's happening? It's just like an operating agreement for a limited liability company.
Okay, so I have friends that just bought a home in Phoenix, and they thought they did everything perfect by putting it in an LLC. Mm-hmm. So, and they own it with another partner. So there's a total of 3 of them. So really, they need a TIC agreement then.
Well, if it's an LLC, they got the operating agreement, but what are they going to do when they go sell in the future? Mm-hmm. They're either going to pay tax, or they're going to have to buy things together, or they're going to have to unwind the LLC, drop it to tenancy in common. And so, I would say you have a choice, and it might be the best way to run it during that ownership is one LLC. But if they're just looking for the liability protection, you could have 3 LLCs, tenancy in common, too. And it gives each person the protection, but it still gives them the ability to exchange out in the future because, as you know, the biggest headache with any exchange is time, and the second biggest is this vesting issue because partnerships aren't exchangeable. So you've got that drop and swap and drop situation. So, let's say 5 years from now, they think, okay, we're going to sell. Mm-hmm. Okay, well, you ought to deed it out at that point to a tenancy in common with a TIC agreement. That changes the bank accounts. You might have a loan that gets accelerated. And so there's a variety of things that happen. So 9 times out of 10, the drop doesn't happen until it's in escrow. And if it happens in escrow, did they personally hold it for investment pre-sale? They're vulnerable. Mm-hmm. They could have a problem. I don't see that happen very often, but if they got the wrong auditor and somebody was mad at them and they wanted to say, well, you personally never held it for investment.
Interesting. And tell me again, how long do you have to own it for investment?
Well, it's not a black and white hold. If you look at 1031, so one of the most viewed videos we have on YouTube is the fallacy of the 5-year hold. And people get, 5 years. What's 5 years apply to? 5 years applies to a property acquired via 1031, converted into a primary residence if you were to sell it within 5 years of acquisition as fully taxable sale. So I'll say that again. If you buy something via 1031, don't think you're going to hold it for a year, move into it, live in it for 2, and sell it and get the exclusion. You're never going to get the full exclusion. There's a 5-year hold, and even after the 5 years, you're going to be subject to the Housing Assistance Tax Act of 2008, which is another conversation. But so don't tell me that buying, converting, and selling is going to get rid of the gain. It doesn't. But if somebody were to just come in and say, hey, how long do I need to hold it? If you and I were brother and sister, I'm going to say 2 years in a related party transaction. If it's just disinterested third parties, I'd say a year typically because it's been proposed a couple times, and that's the break between short and long-term tax rates on assets held for investment. If it's good enough for the government, who are we to argue with them, right? But it has more to do with what you're doing with the property during the time you own it. It's not just a hold period.
Okay, that makes sense. So my friend, I'm not asking for free tax advice.
No.
But my friends that own the property in Phoenix, they're just going to use it as a second home, not rent it out, go and enjoy it. But they probably will sell it in 5 to 7 years.
So when they go to sell it in 5 to 7 years, if it's a second home, it's only going to qualify for 1031 if they restrict their personal use to 2 weeks or 10% of the time it's rented for the 2 years pre-disposition and the 2 years post-acquisition of the replacement. If they just stop using it entirely, then maybe you can get away with a year. So you got to look at it and understand what the rules are at any one given time. And before we started session today, we had the discussion on whether to append this presentation with a date. And that's where I'm always torn on it, because we'll append a date somewhere on this video, but it's interesting because we know what, it's 2025 right now. We know what the rules are, but we still haven't seen what Trump's going to do with tax reform this year even. So things could change then. I mean, 250 or 500, 1997, when are they going to change that? That should be $1.5 million, $2 million or more probably today.
Oh, so true.
Yeah.
So true. Well, let's talk about what's on your list. You have some good handouts there.
Well, this is a presentation I do on end games. Renee said she wanted to talk about end games.
Yeah.
I think one of the things you wanted to talk, you sort of broached earlier, and we'll just do that before we dig into this, is so we talk about big box single tenants, a great end game, right? And just remember that the investment's as good as the tenant and the term of that lease, right?
Yep.
So make sure you got a bulletproof lease and you got tenants that are gold standard people, and then it should be a good thing. What else do we see people do? They go into we talked about institutional tenancy and common properties, and we also talked a little bit about DSTs. Mm-hmm. So. TIC has been around forever, and historically it dealt with, let's say the three of us, CC behind the camera, and the three of us go buy something. That's tenancy in common. And we had rules that came into play in the late 90s, sort of capping the number of investors. And really institutional sort of real estate came in two flavors pre-DST, and that was real estate investment trust, or if you wanted to buy into something 1031 compliant, REIT you couldn't get into, but you'd go into institutional tenancy in common. So if we look at a TIC in today's world, comparing it to a Delaware Statutory Trust, TICs are typically going to be a value add situation. You're buying into a project that the sponsor's going to tie up the asset, and they're going to fill the bucket with investors that reach the brim. They buy it, and then they go through a series of things during that 5 to 7 year, maybe 10-year hold to maximize the ROI, that buildings, whatever it is, get it all up to what it needs to be, and then they're going to get rid of it. And the TIC structure allows people to exchange in and exchange out. One of the issues that comes up, though, is the loans are recourse. And there's really no prohibition against a capital call, which unfortunately you and I lived through, and the benefit of working with more seasoned people like we are, you've gone through some ups and downs. You're no longer invincible, right?
So true.
So I think that there's a number of people, if you think about our market, and you suffered through that last recession, when did the market turn?
Has it turned? No.
I don't think you could not make money for about a decade, it seemed like, with real estate, right?
That's so true.
And Mr. Nelson, I always say this, I'm going to say it. Take a look. I've got a video. It's probably ill-named. Ask the Geezers. I think it's one of the best videos on our YouTube channel. It doesn't have that many views, but I was just joking, tongue-in-cheek with, I have three brokers on there just talking about different things. And Bob made a comment. It's like, real estate's not a get-rich-quick scheme. It's a get-rich-surely but slowly scheme with one golden rule. Don't get yourself in a situation where you have to sell in a recession. I think that is so golden. I think you got to look at the situation right now, but if you've never been through one, you don't know, right? So there's lots of people that have been floating up in the market, never seen a bad day, think they're invincible, which we know we no longer are, and there's where the problems are going to be. So I think to be working with people that have been through the ups and downs, if you're looking at a sponsor, whether it's in the TIC space, DST space, working with REIT people, my advice is work with people that have a little less hair on their head or gray hair on their head, and they've been through the ups and downs, because it will come.
Yeah. Is that why so many TICs failed in the last recession, is because of the value add component and then the capital calls, and just, we just watched a lot of TICs fail?
Well, yes, those, and we had situations where they were actually paying a return on the land. How does that work?
How does that work?
Exactly. So I think the market got so overheated, and I would argue we're not far from that in a lot of space right now. You mentioned North Carolina earlier. There's a couple of groups that tie up land and they will sell to, let's say some program builder, Lennar or Marriott or whatever it is. And so they're making payments on land. Well, how long? So in an upward market, in a market with liquidity, that may not be a problem. But if you get to a market where there's illiquidity, and we had a huge $2 billion TIC sponsor out of Salem that's no longer there, and that was I firmly believe that even though their intent was not even though I believe their intent was correct, but they had cross-collateralized assets, and they thought they got squeezed by banks. And the old saying with a bank, right? It's like, okay, it's raining. Would you like the umbrella? Then it starts raining, they pull it back, right? It's yours until they need it. So
Yeah.
I think we had a situation where they thought the bank was their friend, or banks were their friends, and that created a problem. So it's good till it's not. So that, back to your comment on maturity of the investment and the loan, it's critical to be watching that stuff and understand where we are. And I mean, for anybody that bought property 5-7 years ago, and you might have a loan at 3.8, 3.5, whatever it is, and if you look at replace that loan today, what's it going to be?
Oh, 6.5, 7.
Okay, so and what happens to the LTV? Maybe you might have a capital call, and you might have a property that's gone down in value.
Yeah, definitely.
So if you're not looking at that, thinking about it, understanding you better deal with it before the loan is having to be replaced, you got some issues to deal with. So when you're looking at a TIC sponsor, make sure you're working with someone that's been through those things, and DST sponsors the same way, I'm going to say. But if we go and look at a TIC versus a DST, the TIC, like I said, typically the sponsor ties it up, buys it when it's filled with investors. The debt is going to be recourse. It's a value add play typically. And then, then there is a potential for a capital call. So just be aware of those things. A DST, your ROI ultimately might not be as high, but it's stabilized. Typically you're going to have a multi-asset offering. So a TIC is going to be one asset, where many DSTs are multi-asset, number one. But number two, it's non-recourse debt. Number three, one of the big sins of the DST space, they cannot do a capital call. So their underwriting, everything's going to be different, where they have to be more conservative, and it changes things. So, and we talked earlier about yield versus, wealth preservation, and you just got to really pay attention where it is. And I think the hardest thing for most people going into either one of those spaces is that you give up control.
Yeah. So DSTs are attractive for especially older people who no longer want to roll up their shirt sleeves and earn their wealth, do the value add or renovations on apartments. They just want cash flow in the mail. The DST is attractive to them, but then they get to that edge where it's like, oh, but I got to give up control. So
a couple things. So
what advice do you have on that?
So what's interesting to me is that's the two things that people object to is and either way, whether it's TIC or DST, if you're buying into one, you need to understand, talk to the sponsor, talk to the broker if it's through the broker. And by the way, DSTs are securities brokers, not real estate brokers. Institutional TICs are often real estate brokers. So you just understand, you talk to that person about liquidity, right? Because if you have a rental house you don't like, you sell it. You got an apartment building you own, you don't want it anymore, you sell it. Even if it's a big box single tenant, you own it, you don't want it, you sell it. But if you've got an interest in an institutional TIC or DST, you've got to understand what the sponsor is going to allow you to do. Are you able to get out or not? And we're working on some products that will take care of that issue in the DST space. It wouldn't as much in the TIC space, just because of the nature of the debt, recourse versus non-recourse. So you've got to look at the liquidity of that thing, whether you have the option to get out, and if so, what is that option? How do you make it happen? But number one is the lack of liquidity, and two is the control. And what's funny to me is after they've gone full cycle, and I've had these things where, it's going to be 5 or 7 years, and 2 years into it, the sponsor has decided that it's time to liquidate. And the sponsor is going to do that based upon an earlier ability to reap a nice return. So they see an opportunity to capitalize it quicker, they're going to do it. And or two, if they've got reasons to be concerned about something going on, they're going to get rid of it too. But what's interesting to me is in both those those situations, when something short cycles, a much shorter maturity on it, most of the time they go back into another investment. But the people that were complaining about the lack of liquidity are now complaining that it's short cycled and they're going to have to go buy another one right away. So it's sort of funny to see that sort of boomerang back.
Yeah. Well, for some of my clients, that 5 to 7 year commitment kind of puts them on edge a little bit because you know how fast life can change.
Yes.
And 5 years feels like a lifetime for some of them to make that commitment. And I always just tell them, you wouldn't put money in the stock market and the first time it dips, you're going to jerk it out. That's not a prudent investor. You need to leave it, quit looking at it, watch the news. I mean, you'll get a pretty good idea what's happening, but you just can't have a knee-jerk reaction the first time that there's a blip. We see that even in real estate, that you just have to stay steady. And like you said, it's a long-term growth potential that you're looking for, not a short-term. The get-rich-quick schemes that I see, the late-night infomercials for get-quick-rich, most of those guys are in prison because those don't work. And you need to buy and hold with real estate, and DSTs are really the same. That's what I tell my clients. You better figure you're going to park that money for 5 years. And yes, you have to give up the control, but the benefit is you get a rate of return. And like you said, there are some short cycles that can make an impact on that, but most of the time.
I totally agree. I mean, and the thing you've got to look at, you've got to understand, the investment's as good as a sponsor. And as I said earlier, what good is deferral if the investment goes away? So I would say that we're in a market where wealth preservation is important at this time. I don't think anybody that really understands where we are is looking to swing for the fence at this point in time if they understand it, right?
Yeah.
You've been blessed to work with some great developers in that student housing space, and they've made some. You've been involved with some amazing projects, and those are professional people that do this for a living and has been doing it for a living for a long time. You don't want to go out and throw money into some brand new project for somebody's first deal at this point in time. I mean, there are brand new apartment building. I don't know if they happened in Eugene, but there's an apartment building that's probably a mile from here that finished and went back to the bank. I mean, but you look at the cost and you look at what people want affordable housing. Well, how are you going to do it? You mentioned earlier, whether it's tariffs, whatever it is, just the cost of building something and really the biggest issue we have on the west, up and down the West Coast, is just the cost, the governmental costs to get the shovel in the ground and the time. I mean, you think about how long from the date you buy a property, get the planning, engineering, permitting all submitted before you get a green light. You might, if you buy it, you might be carrying it for 2 years before you can get started on it. What's that cost? I mean, unless you can tie it up some way where that cost is not burying you. So it's really important to understand the QOZ stuff. It's qualified opportunity zone. So another end game, right? So I'm not, we lost personal property exchanges in 2017, and they were replaced with QOZs. So I've got buddies that sell QOZs, a couple of great friends that do, and I always joke with them, I don't like them because they took all my cars, boats, planes away from me for 1031, right? So that was sort of, hit me in the gut with that. So those were fun. But if you look at that, I sort of look at them as a Roth IRA. You've got limited deferral into it, and if you hold it through maturity, it's what you make on it's going to be tax free, which is a wonderful thing. But it's a development play. So once again, you better understand who is putting this thing together, what their background is, and how they're going to be dealing with any potential overruns. And we've had projects through the years that we have people that have said, well, gee, I'm a lien holder in the property, ultimately want to be an owner of it because they like the project. And then when it came time for them to contribute their lien to the new limited liability company and be an owner of the asset, they didn't want to, because now the cost of the project had gone up beyond what they thought, and it was a more attractive situation to be the debt on the property than the equity in it. And then that's one of the conversations we always have with IRA and 401k. Well, do you want to be debt or equity in a given property? There's going to be ups and downs to both those pieces. If we're talking 1031, it's always equity. You don't have that choice. But those situations, it's cost containment.
That makes sense. Well, you've often said that the only people that you see the main people that you see get rich on those opportunity zones are the lawyers and the attorneys that draft the documents, the developer. It kind of goes down in the pecking order to sophistication, maybe would be the right word.
And there's been some amazing projects, some great projects that have done exactly what the whole thing was supposed to do. And then there's been some projects that are not exactly in the spirit of what it was presented to be, I think. And I believe that Trump will, with the reform, they're going to extend all the timelines and continue it, because it has been good, but it's development. So you better be working with people that have been around the block and seen the ups and downs.
Yeah. That apartment that you made reference to near your office that went back to the bank, I'm just curious, why did that go back, in your opinion?
I think it was just the debt on it. I think I mean, think about Palm Springs, Palm Desert area during the the 80s or so, when they had all the foreign money come in, and they go and build all this stuff, but the debt service is too high and it goes back to the bank, and now you get it back out on the street and it's got a much lower debt service. Did it make it that cycle, or did it need another cycle to get to a level that's sustainable? And that's the whole issue. And that, once again, that's your world, is that your old world, the lending world. And I mean, just think about what people make, and you think about what a house is today. And I think one of the things that alarms me, let's say, is think about Musk, and when he bought Twitter, now X, what percentage of the workforce does he still have?
Yeah.
And if you look at AI, what industry is that, or what industry is going to be hit harder than tech with AI? So you look at all Silicon Valley, you look at a 1,500 square foot, $3 million house. I mean, really? I mean, $3 million for that, and you have potential layoffs and so where does that go?
Yeah.
And I think about Oregon. They say, okay, our governor's wanting 38,000 new houses built here, and what's the state population doing right now? Is it going up or down?
I think it's
going down.
Yeah, declining.
So once again, why is the government dictating any of this, since they don't know anything really? I mean, Rush Limbaugh, you say, what's the government do well? Why would you give them more to do, right? I mean, just total disconnect. I mean, if you look at city of Portland, for example, 1031-wise, it's the worst city in the entire country, because they want to keep their hand in the cookie jar. You leave the city of Portland, you have to file paperwork with the city of Portland every year until you either die or pay the taxes that were realized or deferred out of the city. So Oregon and California are about the worst in the country for tax deferral on 1031, because they keep their hand in the cookie jar. But Portland is actually the only city in the country that does that.
Really?
And right now, they're looking at bumping taxes to fill shortfalls for the people that are left, instead of looking at what they're doing and saying, hey, maybe we ought to drop taxes, make this place more appealing, and generate some occupancy and some other things. But yeah, I mean, it's drives me crazy.
I understand. Well, like we said, we're willing to pay our fair share for taxes because of what it does for our area and the environment that we live in, roads, hospitals. But, we also work hard for our money, and you're not an open wallet to just give it away to the government.
Well, the issue, and you deal with multifamily stuff, right? So at the end of the day, why do people end up giving up the properties? I mean, why does somebody come to Rene Nelson and say, hey, I don't want to, or I can't deal with this anymore?
Most of the time, it's because the property's tired or they're tired.
Okay.
That's most of it.
How about any rent control issues?
Oh, well, yeah, they're tired because of the rent control issues. Just cram down on them.
So let's look at that. So when you, so of the big projects you've been associated with, where are they owned?
Most of them are all in the University of Oregon campus
Okay.
area, and all those kids turn over every 12 months.
Okay, and
like
where
clockwork.
do the owners live?
Oh, scattered all over the
Okay,
U.S.
so what are the companies, some of the companies based, are any of them local here?
Nope.
Okay, so 40% of our business it originates locally here. Less than 30% of it finishes here. So even our own clientele is not based here, and the clientele that starts here is leaving. Politicians, please listen.
Yeah.
So, but nobody ever talks to me about any of this stuff, right? And so we sit there and we watch and we talk to our clients and understand where the problems are. And the issue, this rent control issue is one of them, because if you've got Mr. and Mrs. Smith that are now in their 70s, but their whole life they've been aggregating houses and grew up into doors, and now they're being told they can't raise rents, or they're told they're having to buy air conditioners for every tenant, or and they're told they can't, this and that and the other, right? And they keep bumping, they keep saying you can only raise rent to this amount, which isn't even keeping up with inflation, let alone consideration of what's happening with a loan that has to get put back in place and what kind of numbers that puts on somebody. But you had local ownership by people that cared about the tenants, and now you've got foreign ownership. So the money leaves the region and it's owned by people that don't necessarily care much about the tenants. And as far as the rent control issues, the mom and pops can't afford to deal with it. The institutional money, they don't care. I mean, it's a different deal. So I would argue that a lot of these rent control issues, all it's doing is exacerbating the problem, because it's taking local ownership away and putting foreign ownership in. So, and it just goes backwards on a lot of it. But it pushes people into, the things that you're talking about, whether it's an institutional TIC or a DST or a big box single tenant, or maybe they're just looking at end games, installment sales, or some other form of that. But you're really just looking at, okay, what do I do at the end of the day? And so on top of those options and installment sales, people need to understand what the taxation is of that instrument is, and to understand that they better put in place. I mean, you were a mortgage broker. Did you ever deal with selling notes? And if those notes were being sold, did they have acceleration provisions in them, or blind assumption agreements? Or, I mean, so what does that do to the value of something, right? It's like, okay, I'm going to sell. You can buy my property, and I don't want to do an exchange. I understand the tax consequence of carrying paper, which there's a few different things you need to be aware of. But let's say I agreed to that, and if I didn't, so I let, a lot of times the buyer's nice attorney draws the paperwork, right? So who's it reflect? So maybe you buy in short term, you say, okay, I've got 10-year, I think I got 10-year note on it, I get 10 years of income. You buy it, you decide you don't want it, and you sell it. Okay, now I get paid off in that thing, and now I'm gonna get a hit. Now, we might have a solution to keep that thing in place with a structured sale. I mean, there is possibility maybe to move that, or if it's a known trust deed, with do an assignment of collateral, something like that maybe. But if you don't have that provision in there, you got a problem. And then blind assumptions too. I've seen people with blind assumptions where they're just, I'm just going to sign over to Susie down the street. Wait a second, I don't know Susie, I don't know anything. And so it changes. And these sellers, some of them, they don't understand any of this stuff. And the other piece that'll come up is they'll be told that they can just do an exchange when the balloon payment comes in. No, you're not.
That is not true.
Yeah. So
that is the day of reckoning.
yeah. So back to, once again, working with brokers that have been through that stuff. Your real estate broker's got to be somebody that's gone through these things, can sort of explain to you the benefits, the ups and downs of it. To have good tax people are going to help you. And if you're going to carry one of these instruments, you want a lawyer that's going to look at it and make sure if you sell and carry paper, it's yours. It's not the buyer's. So you better have your lawyer look at it and make sure it's doing what you want to do, if that's your end game.
I always tell my clients, have their attorney look at it to put teeth in it to make it enforceable.
Yes.
Because the
Great
attorney is going to be the one that's going to have to do the capital call, do the call to that coming to Jesus meeting of, hey, you've missed, you missed your payoff.
Yes.
We're 6 months behind. We're taking the property back or whatever it is. And a lot of sellers, especially for RV parks, multifamily, that seems like an easy thing to do, a seller carry. Well, instead of me 1031 exchanging into something, I'll just get this installment sale. But I always think, yeah, but what happens if that operator gets in there and they fail, and now you get the property back in 6 months to a year? What's your strategy now? So, for some people, they just want to fade into the sunset and go travel and live life, which I get. You're in that fourth quarter of life. But like you said, you better have an attorney that's drafted all your documents, reviewed everything. I kind of equate it to getting called up for an IRS audit. I'm not going to be the one going. Yeah. It's going to be my CPA, because he's the one that's filed my tax return and has advised me every step of the way on what I can deduct and what I can't. So he's going to go answer the questions. Same thing with a real estate attorney. They're the ones that have the knowledge to protect you. So spend the money. Don't try to do it cheap. Don't do online forms. That is a train wreck. And you'll find out quick the shysters that are out there have figured out those loopholes for documents.
Well, you get what you pay for.
Yeah.
Right? And people don't
True.
want to think about that. And it's whether it's the broker that they don't want to pay the broker for the deal. It's like, what broker's going to do something for nothing? I mean, the one that's not worth anything, right? I mean, so and if you're doing a lawyer, you want to pay somebody that's once again taking a position for you, not learning on your behalf. If you can have brain surgery, you want the cheap guy. It's like I always joke about. I used to scuba dive. It's like, oh yeah, give me the cheap regulator. I don't want the real good one. It's only life support. Come on. Yeah, it's like, so really, you sort of get what you pay for, and it's really okay. So this is your clients as far as conversations with you. I know how you were taught, and I believe it's the way you do your practice. But how hard is it for you to get people to actually talk to you and tell you their story, what they're doing? Because so many young people don't even want to call anymore. They want to they want text or emails. They go, "Oh, what's this cost?" What do you mean, what's it cost? Before you came in this morning, an IRA client emailed, just said, "Well, what's this cost?" I said, "I have no idea. I don't know what you have. I don't know what you want to do with it. We don't know."
Yeah.
Anything until you call up and start talking. And okay, they can go back and forth via text or email, and it might take a week to get to something, or in a 5-minute conversation. So how often do you get people actually able to sit down and counsel in the way you were taught to do?
What I typically try to do is ask a lot of questions up front and really understand their game plan. I'm always curious on what are people trying to accomplish. Are they trying to exit out? Are they looking for cash flow? Do they want to drop and swap, where they want to drop out of an LLC and one person wants to go this way and the other person wants to go that way? Because that is very involved. And the farther we can get ahead of that, and I can have them call your office and talk to them about that, things like that. It's funny because I was just setting up my escrow officer's desk the other day, and I was having this conversation with her about how I try to get my clients to call the exchange facilitator before we even sign a listing agreement, before I even put a marketing package together. And she was telling me that she recently had a situation where they decided right the night before closing that they were going to break out of an LLC and drop and swap. Mm-hmm. And one of them had a tax issue that popped up that they really didn't disclose because they didn't assume that the escrow officer was going to catch it. They went out of the LLC, and then the individual names triggered the title search.
Clouded title again.
Yep. Yeah. So now you got a clouded title. And how often do you see where there's a divorce situation and a spouse is waiting for a house to sell I mean, it's so complex. And I always tell my clients, listen, I'm on your side, but I'm typically like a 6-degree separation of knowing the right person that has that knowledge, whether it's a real estate attorney, a CPA, an exchange facilitator, people way above my pay grade. People that know this stuff
There
because you
aren't
do
any.
it. You do it every single day. So that's my goal, is to help my clients get in touch with the right people.
We had somebody, we're doing the exchange for the wife, and the husband declared bankruptcy in the middle of the transaction. It was California, so it was community property. So all of a sudden we're handling calls, from the court wanting to know and get access to money, and I had to explain, okay, it's 1031 G6 by law, I can't let money out, blah, blah, blah. So, the judge made sure that he was providing me something that was 1031 G6 compliant, but she was so mad that, why don't you let me finish the transaction before you go? He didn't even tell her what was going on.
Yeah.
And it's interesting how people do things and they don't really think about the repercussions of what's happening there. So it's planning ahead and having those conversations. But to get people to actually call up, and so often in the exchange world, you're looking at different structures of things. A lot of times, once again, at the top, we were talking about you don't know what you don't know. Mm-hmm. And so they might have been told one thing forever and it wasn't right. And you start looking at, even think about the ID rules, right? Mm-hmm. And you've got 3 different rules. Each rule works independently of the others. The number of people that think you can only ID 3 properties is mind-boggling, all right? It's entirely untrue, but that's what they think. Or you think in today's world, what's the conversation you're having a lot on? Replacing debt. Right? And so, well, they'll say you have to replace debt in exchange. No, you don't. It's really irrelevant. Okay? It depends on what's happening there and how you're going to offset that, whether there's any tax liability or not. But that's a common statement. Another one is, well, the code says 2 years, the code says 5 years, the code says a year in holding periods. No, it doesn't. So you're looking at assumptions there and different things. But until you really look at it and start asking pointed questions and really get to the bottom line. And as you said, I don't know if you've run across with, LLCs are one thing, but corporations, S's and C's are a whole different deal. Mm-hmm. I mean, when somebody wants to go a different direction in there, just going out goes mark to market and totally eliminates any benefit of an exchange. So if you did distribution of shares of something, you take an asset out of corporation, there's no reason to do an exchange afterwards. You just paid the tax getting it out. So that's why nobody should use those things going forward, right? But there's still some sitting out there from the 70s or 80s or whenever it might have been. And we work with those once in a while. But it's, once again, taking a look at it and then understanding what's going on. I had a conversation with a guy the other day that they did a refi. They pulled the property out of the LLC. Now they're like, well, should we put it back in to get? I said, well, you're going to put it back in, but there's 3 of you in it. 2 of you are going to do an exchange. So no. So look at, okay, so how do you want to ultimately own this thing? If all 3 are in it and 2 are going forward, you're going to have to deed it in, then deed it back out again. I mean, you're changing these things twice. And so it's a question of, as you just said, with that clouded title in that one situation, well, let's say it's a gas station and people don't want that individual liability on that. And once again, understand that the LLC is going to provide you liability protection from that asset, but it doesn't keep you from having the obligation to pay the debt, right, or anything else. But if you don't want to take personal ownership drop from the entity down tenancy in common directly, just do it tenancy in common via 3 LLCs. That each one's got its own disregarded entity. So it's taking the time to plan and paying people that are going to give you some direction on this stuff.
Yeah, absolutely. My clients are going to be so appreciative. Thanks for taking the time today and answering all the questions. And
so one thing you asked about earlier, 721s also.
Yeah.
So, and I think I mentioned on your podcast that we have unfortunately had several different clients pass in the last, 6 months or so. And we have clients that are reaching out to us in planning in advance of it. Maybe they've got some terminal illness. So they're looking at fixing things up. They've got kids that the kids don't want to deal with the properties or can't.
Right.
Or their widow is not going to be, in a situation where they want to saddle them with the responsibility of dealing with all this stuff. So a natural pathway would be an institutional TIC or a DST or maybe even oil and gas. I mean, those things are possible too. Like-kind covers a broad variety of things. The DST stuff is really attractive because it's all non-recourse debt. So they don't have to worry about, they've got to be accredited investors to get into it, but they don't have to go out and fill out applications for loans. And a lot of our clients obviously live off their income too, off these properties. So if it closes and sits in an escrow for 6 months, that puts them in a hurt, where a DST, they could have a check in the mail 2 weeks later. Mm-hmm. So it's really pretty attractive that way. But that 721 option is a really good situation. We had a client that is terminal, and he's like, look, I just want to be in a situation where my widow's not going to have to deal with this stuff, and I'd like to have some liquidity for her in a not too distant future. So in a 721, basically you're exchanging into a Delaware Statutory Trust. It's going to be held as such for a year or two, and then your DST interest uses the 721 process to roll into shares of a real estate investment trust. And the beauty of that is, one, as soon as it goes into that REIT format, that structure, you can sell shares at will. But the second part that's really cool about it is that instead of having to pay tax through the gain until you get to the basis, so normally a lot of times you'll have a conversation with somebody, well, I put $250,000 into it, so I should be able to get my $250,000 out on sale without tax. No, the government's going to flip it upside down, say, no, you pay tax through the gain until you get the basis. Well, a 721, for some reason, they flip it upside down, say you can sell through the basis before you get to the gain. So it gives people the ability, or if you think about that step up upon passing, as soon as you pass, your heir's going to get stepped up basis. They can sell the REIT shares with no gain. So really it's a wonderful estate planning tool if they don't want to go for the 5-7 year ride that a normal DST is going to offer, because it's a 2 to 3 year ride.
Oh, that's so interesting.
Or think about when we had years ago, we had, if you go back to the late 90s, that 2000, that we had the tech sort of bubble, the crash, but then all of a sudden it went nuts and people were just, and I remember Bob sitting there and saying, well, what do you tell the person that wants to take their money and throw it into Wall Street? It was like, good luck, because why wouldn't you at that point in time? There was a window there.
Yeah.
So in that situation, the problem with doing that is obviously paying the tax on the gains to go make that investment. How long does it take to get just what you gave up there to get there, right? Instead of using, let's say, 721 sitting in your hands for a couple of years. Or you said it earlier, a cash out refi. So I'll say this, a cash out refi, if you want money out of a deal, you can do it either before the exchange or afterwards. If you do it before, it better be before you ever put the property on the market, or it would be looked at as a step transaction. If you want to pull money out after an acquisition, it could happen a week later. So maybe you have a short-term seller carry, 30 days, 60 days of permanent financing comes in, and at that point you can get money out without tax, and then you diversify that into Wall Street or buy a house or whatever you want to do.
That's a good strategy. Yeah. Yeah, I do have a lot of clients that ask me about cash out refis, and I always say, do it before we even get ready to sign the listing agreement.
Exactly.
It's going to take you, if it's commercial, it's going to take you probably 60 days to get through the lending process, and you're going to want to do that sooner than later if you want that cash out.
If there's a reason that it's happening. So last week I was talking to I actually got referred in the deal by a mortgage broker that had done this with us in the past. So you think about a reverse exchange, for example, and a reverse requires the taxpayer has the ability to buy without the other property having sold, right? So they got to have money to buy from somewhere. So what this broker, they was going to say, okay, well, can we refi the property that's going to go away, pulling some money out to go buy this thing? And normally you'd say no, because as we just discussed, it's a step transaction. So what we do in that situation is say, okay, pre-cash out refi, you had this much equity in the property. Post-acquisition, when the exchange is all done, we can track every penny out of this thing, the cash out refi money and the net equity we can show went all the way forward into this, then we don't have a problem. If all that money did not go forward, the money that didn't, you could say was step transaction and an issue there. So it sort of depends on what, maybe you're going to lose the property foreclosure, you have to put a new loan on it, and then you get the loan done, and then you decide, well, I'm done. I get rid of the thing. Well, could you do that? Yeah, the answer would be you buy a property that was a great purchase, and the neighbor says, hey, I wanted it. Makes you an offer that's too good to pass up. Could you sell it? Yes, you could. How often does this happen? There's a court case, Clarkowski, that's 9 points used to determine dealer status. 1 or 2 strikes, not a problem, but you start stacking them up, you got an issue. And I use that same court case. You've got IRA-owned real estate, so I would use that same court case to look at whether somebody is subject to something called unrelated business taxable income in the IRA space. So, and it's not reason to do or not to do a given investment. It's just another factor to look at with the ROI on a given investment.
Yeah.
Whether you're conducting business, so whether in the tax world, if you're conducting business or investment, if you're flipping properties, it's a business, right? So one, it doesn't qualify for 1031, and two, you're not getting normal income tax, or you're paying normal income tax. You're not going to get long term. So you got to look at that, and that's why people that flip, sooner or later, they're going to figure it out, right?
Yeah.
You don't want to do that. So we look at flipping property would be a business situation in the tax world, and that same thing, or having a leveraged investment in the IRA 401k space. With IRAs, any income or gain attributable to other people's money triggers tax exposure. So we sort of look at these issues in that space too.
Yeah. Well, thanks again for all your advice and strategies. My clients will be very appreciative.
Well, it's great to have you here. And so what are you working on right now, Rene?
Let's see. I've got an RV park listed for sale.
I saw that. And where is that?
That's in West Fur, Oregon.
Okay, so Oregon is one of those where basically you have to offer it up to all the tenants first. They've got first right of offer on it.
Yeah, we did do that.
Yeah.
All the tenants knew that it was going to go up for sale, so they just wish the owner well, and we've got that on the market, and I'm working.
Those are pretty hot commodity right now.
They are.
Yeah.
They really are.
So on that one, Rene, what percentage are they all owner occupied units, or does the park itself own any of the mobile homes?
Luckily, no. That's not
Luckily, no.
Well, that's not an ideal situation for the park to own them, because then you have to maintain them.
Exactly.
So tenants own all the manufactured homes or RVs, and then there's daily, weekly, and monthly rentals, because the majority of, especially the pull-through spaces for the big rig RV spaces, have riverfront access and views of the river. So it's pretty spectacular.
So how long had that owner had that property, owner-operator had that property?
It's funny. Bob and I sold that to them 12 years ago.
Wow.
Yeah. And they're just at a stage where they want to travel full-time in their RV. So that's their motivation.
What are they going to do?
They want to do an owner carry, and they really want to get in their RV and just travel. So I'm marketing it right now. We've had a couple of offers, but it's been more from big capital companies that want to come in and buy it for 30 cents on the dollar, and my seller's not motivated to transact at that level.
They don't have to.
Yeah, they don't. They do not have to. They have a small mortgage on it in relation to the value of the property. They're maintaining it. They have a house right there that's on the river. So they live in this very peaceful, tranquil situation. It's beautiful up there. But they also would like to just get in their RV and travel year round and just go see the world, or see the United States. So that's their motivation.
So if somebody's curious about the tax ramifications of a seller carry, take a look at our YouTube video. You can just type in Equity Advantage Seller Finance, I believe, and there's a variety of things you need to be aware of on that. But like we said earlier, make sure you got a prepayment in it.
Yep.
And you don't allow any blind assumptions.
Yes, and have an attorney draft
Have
it.
an attorney draft it. So yeah, I think it's one of those things where it's great. And like I said, a structured sale is sort of a it's taking, and the big issue, obviously, aside from the tax repercussions on an installment sale, is just worry of buyer default. And you mentioned earlier, there's loan servicing companies there that will go through that stuff, but have an attorney there, because if it does go into default, you don't want to be the person sitting there trying to get that thing made whole.
Yeah.
But it's sort of interesting. You look at that stuff, and there's structured sales. Really, what happens in that space, you've got a third-party assignment company that assumes the obligation to pay, and they can do that over any given period you want. So those things are sort of neat. And actually, I was told there was a company years ago that would take the money and invest it too in Wall Street. And from what I understand, that's something that's out there again. I've got to get more. Got to get old Rick out here to do one of these with us, so we can have that on and up, so people have an understanding of what's happening in that space. Deferred sales trusts, the other DST, just if you're looking at that, understand, one, it's got to be unencumbered dirt. It's got to be a certain value, not dirt. It's got to be unencumbered land. But it's one of those things where it has never received formal government approval. So I would say make sure your tax people are okay with you using that instrument. Sorry for the DST people pushing out there, but until I see something that says it is, it's not. So you just sort of need to look at what's there, and what your options are, and timing sales obviously is another thing. I'm rattling through other end games because Rene was talking about that earlier. Timing the sales. When do you want to get that tax consequence? What options are you looking for as far as passive stuff? Typically, it's the big box stuff we discussed. Institutional TICs, DSTs. Sorry, people, a REIT is not real estate, it's a stock. So if you're wanting to buy real estate, and this is a discussion I get in with the DST sponsors too. I go, guys, you got to open your product up to IRAs and 401k. I've talked to sponsors, and they're going, oh, why would they want to do? They could buy a REIT. I said, they don't want a REIT. A REIT's a stock, okay? They want to have the benefits and burdens of owning real estate, okay? Do you understand that? So I was like, yeah. So that's one of those things that we're working through with that space right now. But,
Keep working. Maybe you'll wear them down.
Yeah, and the QOZs, I think you talked about homes earlier. For people that have gains in excess of 250 or 500 that don't want to convert things, they're looking for some ability to mitigate some of the tax. I think the QOZ is a good option there. The mobile home park we were discussing. Imagine if the park owner owned a bunch of the mobile homes. Now that's personal property. So you've got to look at personal versus real property allocations and how that impacts an exchange. And then be aware of those things. Obviously, it's ideal if they don't own that personal property. Business transactions, same thing. I mean, you sell a piece of property with business there. You've got allocations, different directions. Who made those allocations? What do you really want it to be? I mean, and that's one of those things where the buyer and seller fighting over what is what. But a lot of times I've dealt with transactions through the years where the seller had originally put a huge number on the business, let's say, and a small number on the real property component. And by the time you start talking, you say, well, what are you going to do? Because on the sale of that business, we used to be able to do exchanges of the business, but today we can't. So the more the business valuation is, the more gain there that you can't really do anything with other than an OZ. So, what are you going to do with that stuff, and how do we keep, once again, their money theirs? So, it's just getting people to talk and sort of open up with respect to what they have and what they want to do with it. And that's the big key. And I know that's what your strength is. So any other big projects you're working on?
Just closed 2 big transactions, apartment complexes. Yeah. One was $14 million, one was $11 million. Nice. That was really fun to work on. That was a family in Eugene that I helped them. They're preserving their family wealth and building a legacy. So generational reigns being passed to adult children. Right. So that was just like a cherry on top for 2024 for me. It was a great family to work with. Good. Super fun. And, that's kind of the joy of being where we're at in life. We're probably all at a point where, yeah, we probably could just retire if we wanted to, but now you get to pick and choose who you work with. And really, most of my clients are my friends, and
That's wonderful.
I'm just at a stage where I want to help them because I want to make sure that they're prosperous and that they're earning every dollar that they can for their property and have that passive income to create that peace in their life too. So life's pretty dang good right now.
I don't know why. Well, I don't know why. As we get older, it's so hard to sleep at night. But I just want to sleep through the night, right? I don't need any more stress to add anything else to it. But isn't that funny?
Yeah.
The little kid, they sleep through anything, and
There's some pretty good sleep apps out there, Calm and Headspace.
I'll have to look at that. I actually had looked at the Headspace one. I hadn't seen the Prom one, but anyway, it's interesting, all that stuff that's out there. Then you want to say, okay, so as soon as you listen to one, say now you get bombarded with more on that, right?
Yeah.
So the wonderful world. Thank you, Rene, for coming in today. It's been fun. We're going to do this again. I want to hear more about the projects. And man, you were definitely doing a lot of the big changes down there at U of O. And I'm an adopted duck, like you know.
Yeah.
I married into a big duck family, and I've got 3 of my own down that went down through that school. So it's fun to see Oregon doing what it's doing. And Eugene was sort of funny when I moved up from Santa Cruz. Eugene, I felt like was a sister city to Santa Cruz. Immediately liked it. Immediately felt home. Not so much with some of the other cities in this state, but that was always a neat place. I always enjoyed being there. So thank you. It's been a pleasure to have you as a friend through the years, and thanks for coming up and doing this. It's fun to work with you too.
Yeah, I've had a blast. Thank you for having me, and thanks for sharing all your knowledge. My clients are going to be so appreciative.
So where do they find you, by the way? Where do people find you if they have questions about multifamily stuff in this state, and especially down in the Eugene, Oregon area? You've certainly done a lot of the big projects there. So how do they get a hold of Rene Nelson?
Well, probably the easiest way is go on LinkedIn and look me up on LinkedIn. All my contact information is on there. I'm sure CC will drop in the notes to my contact information, my email address, phone number, but LinkedIn is always a great place to connect with people.
And how about you've got your toe in the water, jumping in quickly with the podcast world too. How do they find out more about those?
Yeah, so I just started a podcast this year. It's called Commercial Connections. Really what I wanted to do was just kind of demystify investing and teach everything from a beginner to an experienced investor. I've had lots of good guests on like yourself, and I've had lenders on and appraisers. And my goal is to just really help educate people about the commercial real estate investing opportunity. A lot of people earn money and then they want to invest it and grow. And they think, well, I'll put it in the stock market. Well, the stock market can be a little tumultuous at times. And getting into real estate just creates that passive income that you need for your retirement portfolio. So I've spent my whole career in real estate and just love it and believe in it. So I own it myself. I wouldn't advocate for it if I didn't own it. And if I haven't been through the ups and downs of owning it and tenants and then giving up ownership and hiring a property manager, I've been through it all. So I'm just trying to pass the information on to people at this point.
Well, it's the ultimate investment, right? I don't think there's an older investment known to mankind, and yet it's considered an alternative investment in the investment world, which explain that to me. It drives me crazy. But if you think about anything else in life, in recessionary times, they say put things into hard assets, tangible assets, and everyone talks about gold. It's like, well, for gold to make you money, what has to happen?
Well, it has to go up.
It's got to go up. All right?
Yeah.
For real estate to make you money, does it have to go up?
Not necessarily. You hope it doesn't burn down.
Yeah.
You hope your tenants don't bail on you. Yeah.
But if you bought something, 50% loan to value, a 10-year loan, right? 10 years later, you doubled your money, whether it went up a penny or not.
Yep.
And meanwhile, you had all the cash flow, you had interest deductions, depreciation the whole time you own it. At the end of the day, what you make on it, you can 1031 in the next thing and pay no tax. So People, real estate, the ultimate tangible asset. So
That's right.
David Moore, Equity Advantage, IRA Advantage, and blessed to have had Rene Nelson of Pacwest Commercial out of Eugene, Oregon with me today.
Thank you. Thanks.